Good day to one and all. This is Dr. Sivaraman of iknowindices.com. I was presenting Tracking the Forex Market Together webinar between 9 and 9:45 GMT during the European session. So I will now take up the part 2. So in part 2, we are going to review the market by using the live market code page. I focus the camera over that of the live market code page. I also given link and you should be able to see the live market code page. Currently Euro is trading around 1.4251, 1.4253. They are making a dip, and 1.4150 is the low, and during that of the European session 1.4261 was the high, and subsequently they made during that of the gap time. I was talking about the gap time moves. So it went up to 42.90 and came down, and it started making the swings around that of 41.61 and little bit of upward move, and then after the data release they started making the drop. So this is what the gap times they use it to in order to trigger the stops on the upside. And in the case of GBP, we had the initial high, the low was in 61.68, the high was during that of the European session 1.6297, and then subsequently made the drop, and then they during the gap time they formed 1.6311 and then started making the drop. So if you are very clever or if you are a smart trader, then when they rise during that at the gap time, you can just take a sell position and keep stop at entry once it shows profit, and during the session start time when they drop, you can trail the stop and book profit. So that's referred as a gap time trade, just for your information's sake. And USDN is trading in the same range, but they breached the initial low 76.61 and then formed 76.53 and holding it below that 24 pips negative net change is seen. And in the case of USD CHF, they are not breached the high or the low, and they are trading around that of 77, the psychological level, in order to take it upward. You come across 93 pips positive net change in the case of CHF, whereas in the rest of the majors, you find that Euro is showing about 15 pips positive net change currently and 49 pips positive net change in the case of GBP. Then coming to the commodity pairs, Canadian dollar is trading around 0.99 or 9899, and in the low I kept a buy order that was not filled during that of the European session, and they cut the high. The high was 98.93 and they breached and formed 99.07, 57 pips positive net change is seen. In the case of Australian dollar, they have not breached the initial high what they have set during that of the Japanese session, and during the European session I kept a sell order at 1.0355. They have not filled it, and I took a sell around 1.0348 and then made a nominal drop. Again they came up, and again they are making the dip. So here they are holding high and just building sell positions in order to drop it, and irrespective of the data release they will try to show the moves and just give some sort of explanations. And among that of the European crosses, Euro GBP, I was telling that 97.41 is the low, so it is not advisable to sell around that of the low when the low has not been breached for more than 30 minutes, and they made a pullback to the middle level between the low and the high, that is 87.67, and then started making the dip again. Now 16 pips negative net change is seen. And in the case of Euro CHF, I kept a buy order at 1.1001. They filled it and came down very fast to 1.0973, and I kept stop at 50 pips below, and they hedged me, not the stop hedging, they filled the hedge and then came down and suddenly went up. So my stop at entry was filled in the hedging, and then I closed the position. I'll explain all those things by using that particular chart. The high is 1.1046 that they are not breached. So they made the nominal swings in the case of CHF because there is only one currency which is showing a very good spread, and it has made about 94 pips positive net change, and also Euro CHF is showing about 150 pips positive net change. So you come across the high in the case of euro is being breached during the gap time, so they wanted to drop. We can easily read out from there. And in the case of GBP also, they set the new high only during the gap time. And then CHF, they have not done it, either breaching the low or the high, and Canadian dollar also the same, and Australian dollar also the same. So only in the case of euro and GBP, they made a brief upward stop and before making a drop. So let us review trades what we had taken during the European session. So I explained what happened to that of the highs and the lows when compared to that of the European session levels. So when you refer to that of the highs and the lows, you are able to really understand that market is in small swings. Otherwise, if you look into that of the individual charts, probably if you look into the CHF charts, you might think that USD is gaining. But when you look into that of euro, you might be thinking that USD is weakening, and that will give the confusions. But we know that whenever the net change is positive in all the four majors, then we understand that they are making contrarian moves, because the numerator currencies are showing the USD weakening move and the denominator currencies are showing USD gaining move, and that sort of moves are referred as a contrarian move. Now you come across that euro and GBP are making the dip and still in the positive net change level, but in the case of USD CAD and Australian dollar, they are showing the USD gaining move. Still the contrarian move is there, so they are not expected to make very big moves when they are doing this sort of contrarian moves. That means they wanted to handle the crosses more when compared to that of the majors. So coming to that of the positions what I had taken during the European session, and at the time the high was 1.4256. I kept the sell order. They filled it and went up 30 pips above 1.4286. That was hedged, and subsequently I kept stop at entry. In the live market code page you can see 1.4290 is the high, and then quickly they made the drop. I closed it with stop at entry, and then subsequently I kept 30 pips above another hedging order. When they started making the drop, I just kept stop at entry and closed it with zero profit, because I wanted to close the positions during that same session. So it is possible once you systematically trade, and again next session we can take another sell position and try to book profit as well, or a buy position and try to book profit. So we are not biased, we are not bullish or bearish, we try to read the market and try to take positions. Then in the case of GBP, I kept a sell order at 1.6290, then it was not coming up after forming 1.6297. Then during the webinar time, so I modified and took 6287 when they firmed up. Then subsequently kept 30 pips hedging order that was not filled, and then subsequently they made the drop around 12:30 GMT, and I closed it around 62.63 with 24 pips profit. And USD CHF, I kept a buy order at 77.12, and they came down quickly, filled it, and subsequently came down a little bit to 77.83, and my hedging was not filled, and then they took it up to that of 77.29, and then I closed it around 77.26 with 14 pips profit. In Australian dollar, again I kept a sell order at 1.0355, that was not filled, and even now they are not gained it, and they came up to 1.0347, and I took a sell position and 30 pips hedging order, and subsequently they made a nominal drop to 1.0334, and I booked 13 pips profit. And Canadian dollar near the low, I kept a buy order that is not filled, and they have just taken it up. Then in the case of Euro CHO, it's a very interesting aspect how hedging can be used effectively. I kept a buy order 1.1001 when they are around that of 1.1046 or 1041, then 27, and then below that market 1.1001, I kept a buy order with 50 pips hedging order at 1.0951, 50 pips below, and they quickly made a drop, and afterwards my hedging was filled. I kept stop at entry, and they came down to that of 1.0930. I am not bothered, because I know very well that they are here to hit the stops. So once it is hedged, then I kept a stop at entry at 1.0951. They quickly gained the level to 1.0973 and then to 1.10 and went up to 1.1037. I closed it around 1.1033 with 32 pips profit. So within the session, it is possible for us to close the positions and again look for new trades during the next session. And that way, if you do it, we will not incur huge loss because many of the traders have got the tendency to take the positions without a stop and they continue to hold it for 2-3 days and become panic. Instead, you can use the hedging to limit the risk, and when they go opposite to our expectations, immediately we close our original position and try to maximize the profit with a hedging position. So we are risking at any given time 30 pips with regard to that of the majors and the commodity pairs, and with regard to the crosses 50 pips. So this is the fate of the trades what I have taken during that of the European session. So now we will again redo the entire exercise, how my trading system works. So my trading system includes the timing of the market as well as that of the levels. So we follow the timings because each and every session they try to alter the sentiments in the market. That is referred as the intraday reversal moves. So we need to understand the intraday trend reversals and try to trade so they are not going to drop continuously throughout the day or continuously rise throughout the day. They are expected to make the oscillations in the market. So that we should be able to read beforehand what they are trying to do. I have given an example that, so first of all, Japanese session is 0030 to 0700 GMT and gap time is between 7 and 7:30 GMT. And 7:30 to 13 GMT is the European session. That around 9 GMT we just took some position and closed before the 13 GMT. Then gap time is between 13 and 13:30 GMT. I was explaining with regard to the gap time trade. They made the upward move during that of the gap time in the case of Euro and GBP and formed a new high. As I explained, gap time moves are false moves. So afterwards, when the session starts, when the data was released with regard to consumer sentiment, they started making the drop. So we know that they make an upward stop and during the gap time to make a downward move during the session. So 13:30, the US session starts. Invariably, you come across around 12:30 GMT or 14 GMT. The data release happens, and invariably they make some volatile moves and afterwards set the trend. So when you follow the gap time move, you can understand that they are going to drop only during the US session. So let us review whether it is happening or not. Then again during the gap time, they will try to make the stop ends either on the upside or on the downside. So this gap time moves, when you understand that they are false move, we can easily read is going to be the next move in the session. So for that, we need to understand the market timings. So how do we go about in taking trading decisions? So first of all, we use GMT time to track the market. And when you use the GMT time, I also given that session timings in GMT so that you'll be able to easily understand that 24 hours market can be split into 3 components, and in between you find the gap times. So when you track it, you'll be able to understand it is a 24 hours market and a full day it takes for the in order to make the moves. So when you understand that it is a 24 hours market, unlike that of the stock market, which is about 78 hours in a particular country, it is a world market. So we need to track it using GMT time. Then each session, we need to understand that there is a gap time before the start of the session. Then afterwards, 1.5 hours from the start of the session is the early session, and 1.5 hours towards close of the session is the late session. In between is the mid session. So during the early and the late sessions, they handle the majors. You could have seen that quickly they handle the majors during that time. Afterwards, they will come to that of the crosses. So during the mid sessions, they will be handling the crosses, and that you can watch how exactly they are handling the crosses by rising or dropping European crosses, yen crosses, etc., and commodity crosses. Then use the live market code page. I have given the link, and if you try to watch it, with frequent intervals, you will be able to really understand. There is no real requirement of a chart. In fact, you will be able to understand when you try to relate it to that of the high and the low, whether the market is near the high, just consolidating there, or near the low, consolidating there. And you will be able to also see the live price action that will give you that indication whether they are doing a stop and or whether they are doing the false move or an extended move or whatever the other type of moves. I'll explain it later. So when they are near the high or they near the low, only we are taking to take the position, and we always relate it to that of the highs and the lows. Then we take the trading decision. So first of all, we identify a currency which has made more than 40 to 50 pips spread between the low and the high. And in those currencies only, we try to take positions. During the European session, I have not taken position in the case of yen because it was showing about 39 pips spread between the high and the low. Now you find that in yen, they made a downward stop and from 76.61 to 76.53 and come above 76.72, 76.75, they are showing it. So always a pull down and then go up quickly. That is the type of move they do it. So it is a downward stop and before making a rise, they know very well those who have got that long position, they normally keep the stop, tight stop below the low, and they know up to what level they could have kept, and probably people would have found that what 76.60 or 76.59 is a strong resistance and support, and they could have kept the stops below that. So the players know where the stops are. They hit it up to 76.53 and went up. There comes the constraint when you blindly follow the supports and the resistance. Otherwise, they work in the market, but we need to understand how far they will be able to do the stop-ins. If you are a smart trader, when they do such stop-ins, we can try to take positions so further stop-ins may not happen subsequently. So when the market is closer to that of the high or the low, we try to take positions. When the market is in the middle level, we avoid taking positions. After the drop, we don't sell, or rise, we don't buy. And they are all emotional trading and we might be trapped. Now, with regard to the entry decision, when the market is near the high, not cut the high for more than 30 minutes. Now in the European session, the market, they set the high in the case of Euro and GBP during the gap time, and afterwards for the first 30 minutes they are not breached the high. So it is unlikely that they will breach the high during this particular session. So this is the conclusion we try to take first. Then what could be the entry level? So when they have made the drop, so we should not take sell position there. That is an emotional selling, because normally they make a drop in order to induce the traders to sell, and they know that negative news is there and the traders will think that risk aversion is going to happen. So immediately they will sell after the drop. Then what the players try to buy those sells and pull it up a little bit and induce them to do the short covering and continue to drop. So when they make the pullback, we try to take a sell. Then probably we will not be stopped out. So this is how we fine tune our entry. So it is not that we have missed that opportunity. Market continues to give that opportunity. They will not just like that drop it, and they have to induce the traders, those who have gone lower level short, to do the short covering, and subsequently induce the traders to take a long position at a higher level. Then only they will make the drop. So just like that, making a rise or a drop, they don't make money. They want the traders to emotionally commit a wrong position. Then they try to trap the traders to earn money. So this we need to understand so that we will not be in a hurry to take a position. So now you would have seen that Euro, they made the drop and subsequently they are forming top. This is what day in and day out happens in the market. So only if you are patient enough, then we will get a very wise level sell position or a buy position in the market. Then equal to that of the entry, the exit is also very important. So once you decide to enter near that of the high sell position, then our immediate exit point will be the low set for that particular day. Statistically, we may calculate that Euro might go to 1.38 or 1.41 or whatever it is. But intraday, if you want to close the position, near the low will be the exit. So the low in the case of euro is 1.4150, and before that the initial low was 1.4201. So we have to find that 1.4201 the breaches before going to that of the lower level. So we have to watch for that. So initial low level you can keep a buy order. And if you think 1.4150 is the low, then you might become bearish, but you have to understand the initial low was 1.4201, and then subsequently they made a downward stop, and before making the rise during the European session, they made that upward stop, and now they are making that drop. So in the case of Euro and GBP, they are making either way stop and moves on a daily basis, because the players are focusing more on that of the denominator currencies, namely USD-Yen and USD-CHF. Now USD-CHF is in the limelight, and they are trying to accumulate the position after making a very big drop during the early part of the week, and then subsequently they are buying all the level selling. Then we could come across one-sided gains in the case of USD-CHF and also the CHF crosses. So you may call it as a verbal interventions and things like that. And the verbal intervention did not come before the drop. So if you think about it, then you can understand how they play around with us. Then, even though you read the market very well, you are able to decide upon your entry and exit, the stop or the entry stop, namely the hedging, is very, very important for us, because we cannot afford to take unlimited risk, especially the small traders who have got the equity of less than $30,000 as an available margin. Because when the market makes about 150 pips rise on one day, the second day another 150 pips, and third day they can rise only 50 pips. But during the process of rising 350 pips, if you accumulate sell positions, then your usable margin will erode like anything, and then automatically you will be induced to do the short covering. Later on you find the market drops. So in case if you want to trade without a stop, then look for position trade. In that, the most important thing is spread the risk. So at 1.42 you are taking a sell position. The next sell will be 1.43 or 1.4350. In case if they show it, take another sell. And for that, at every time, you take only 1% of your equity, the position, spread the risk like that as a widespread trade. Then keep in every position 100 pips limit. Then you will be able to see when the market goes up, you will be taking one more sell. When the market comes down, you will be able to book profit. So there are only two possibilities in the market. It can either go up or come down. So when they go up, you will take one sell position extra. And if you keep about 5-6 sell orders every 150 pips, it will be almost closer to that of 900 pips. So if you know that in the market, they invariably make only a wide spread in a month of about 1000 to 1100 pips. So even if you take 6 positions, 6 mini lots in a 30,000 equity, you will not get margin call, but every trade you will be able to book profit during the drop, because they cannot continue to rise the market, continue to drop the market endlessly. That is one type of trade. You have to plan it beforehand and then try to do it. And just because the position is making loss, you should not say that I am into position trade. That's the wrong approach to that, because you are not able to think about how to handle the position. So keep 30 pips hedging order. That is what I explained it during that of the European session. So when your hedge is filled, you are not worried, perturbed. You simply keep stop at entry and let them take the market anywhere they want. And automatically when they reverse, you will be able to see that hedging is closed and you continue with that of the original position. This is one of the advantage of using hedging. Then once the position makes about 20 to 25 pips profit, you keep stop at entry, then automatically you find that you are not taking any risk regard to the position. So avoid holding loss-making positions and try to keep stop at entry as soon as possible. In the event if a position is not making profit for more than 2 hours, try to exit out of the position, because invariably it may maximize the loss. So this is how you should be able to decide with regard to the positions and also use the hedging to limit the risk. Then the entry and exit can be fine-tuned by keeping limit orders. So during the European session, I explained how exactly we can keep the limit order slightly above that of the market. If they fill it fine, we get a fine-tuned entry. Then if they don't, then after watching for about 30 minutes, you can modify and take the position in the market so that we will not be hedged very quickly. During the drop, if you quickly quickly take a sell position, when they quickly rise, you might be hedged. Then later on they may drop and you might find that it becomes a distressed trade. So avoid the impulsiveness while trading. That can be done by taking very less positions in the market at a given time so that you are not risking your life you are not risking your reserve. Only with the free money available for trading, you try to trade it and do it as a joyful situation and try to understand it very well. Then trading becomes a child's play. Now, in the event if they breach the high, what I have seen in the case of GBP during that of the European session, I was telling you that at that time they came up to that of 1.6297, so they are expected to breach the psychological level 1.63 before making a drop. So I kept a sell order at 1.6290, but they are not raised at that time, but during the gap time they gained the level and went up to 1.6311 and made the stop hunt and then subsequently made the slide. So this is how they do it. So the start of the session, end of the session, if you try to take positions whenever they are near that of the high or whenever they are near that of the low, then your trade becomes really easy. So the type of moves what they do in the market is the stop hunt. During the gap time, either a stop hunt or a false move could be seen. In the case of Australian dollar, they made a false move. They came up to that of the high 1.0355, but they not breached it and came down. It has got a purpose. So they do not want to go up. Why? Because there are a lot of long positions in the market. So they do not want the long holders to book profit. That is why when the longs are more when compared to that of the short selling, then automatically they go up to that of the high, give that impression to that of the long holders. It could go up so that they will not book profit, and the short sellers will come for the short covering, thinking that it will go up. Then afterwards quickly they drop. So they come down to 1.0314 immediately and now hovering around that of 1.0334 currently, and they are expected to make further slide because in the first 30 minutes they are not breached the high. They are unlikely to breach the high. Then we understand it is a stop hunt. Extended move, they go above that of the high, stay for more than 30 minutes, then they rise up to 2 hours. Afterwards, if you try to take a sell position, you will be able to see profit. So here the type of moves give us the timings, what you have to wait, then take positions in the market. So it is not necessary that highest level if you take a sell position, you should be able to book profit, because many of the traders have got the feel that at the highest level they wanted to take a sell position or at the highest level they want to book profit. In case if they book profit afterwards, if the market goes up another 20-30 pips, they repent. I could have waited and booked profit. But that feel is fine provided you use a trailing stop. But if you simply take that particular feel that up, okay, let it go further high, then I'll book profit. Let it go further higher, then I'll book profit. They will quickly make a drop and your position will be making loss. So it is not the forecast alone which is going to help you and earn money from that other market. We also need to use the trading strategy, how expert you are, namely the stop or the hedging order and keeping stop at the entry and also trailing the stop, and you can trail the limit also to maximize the profit. Simply watching it and looking into that other chart, okay, they may rise another 100 pips and you may wait. Suddenly there might be a breakout of the news and they will quickly drop it and you will be caught unaware. So unless and otherwise you use trading strategy, you are not going to wisely earn money from the other market. So when they make an extended move, wait for 2 hours, then enter or make a counter trade. When they rise, then take a sell position. When they drop, take a buy position. After 2 hours, then You know that intentional move is the extended move is a quick move. Always the quick moves are false moves. And I have given the example during that of the European session. In the case of USD CHF and the Euro CHF, they made a very big drop, nearly about 300 to 500 pips drop. And that is a very quick drop. And anybody will be wondering why such a drop. And are there people just buying it and liquidating the positions? No, not at all. The players do the circular trades. They keep a lower level buy and sell it to them and keep another 100 pips below another buy and sell it to them. Quickly you find in a fraction of a second the market comes down because they do only circular trade. No, I don't think anybody would have taken a sell position during such drop thinking that it can drop up to 500 pips. So people only think of buying it during such thing. And immediately the players sell to them and drop it. So because of the margin pressure, the traders close all the positions. So they drop it up to 0.71 and afterwards you find that it has come to 0.77. But the drop took a few hours on Tuesday US session. But now on Friday, you find they gained almost all the levels. So gaining the levels, it took nearly 3 days. So this is how they make the moves. Quick moves or false moves in the market. Don't be afraid of it. But only thing is, let them stop the move, then you enter into that market. If you think that it is a falling knife, then you will not be able to catch it because the players are buying at that time. Anybody is liquidating the long positions at that time, they are buying. No, they took Euro CHF almost to that of parity, 1.0077, and then from there they took it to 1.10 level. So this is how they play in the market. So this play, if you are able to understand, you can trade. Otherwise, you might find the market is really not worth making trades. Okay. In this session, this is a forecast, so we use it only as a guideline that Euro and GBP are expected to make the swing and drop more. They initiated the drop, and let us see what sort of trades we can think of. Now, Euro is trading around 1.4239, 424142 level, and you know that initial high was 1.4256, and then subsequently they made the drop, and they made an upward stop and came below that of the initial high and still holding below that of the initial high. So a lot of people holding long positions will come for long liquidation. So what we try to do is we keep a sell limit 1.4256. That was the high, initial high. They may come up to that and then make for the drop. So we just keep a sell limit order. If it is not filled, no harm. Next session is available for us to trade. So that is how we have to keep in mind. Market continues to give trading options. Then we keep a stop because most of the US trading platform, they don't provide the hedging facilities. So I'll just trade that of a stop. So similarly, in the case of GBP, the initial high was the high what they set during that of the European session was 1.6297, and then they made the drop, formed a new high 1.6311 in the live market put page you can see, and they are trading below that of 1.6297. So we will keep a sell limit order 1.6297 with an entry stop of. So at a given time we take only 30 pips risk, and if the going is good, we keep stop at entry and then try to accept the profit by using the trailing stop in the profit making position. In case if it is hedged, then we have to effectively handle the hedge. In the event if you keep the stop, then once it is stopped out, you just imagine, okay, I am stopped out 30 pips above, and that particular stop level is making profit or not. If for a sell position, I am only buying it. That is the buy to close the sell position in the absence of hedging. So if that particular buy position is not giving profit for 30 minutes, you can re-enter in the market as a sell position. If that buy position is giving profit, then you can buy during a small dip. Then you will be able to see that market goes up further. So with the help of your levels, you can estimate the market very easily rather than going for a complicated statistical analysis. Statistical analysis also try to give you the same information. Then USD CHF 0.7708 to 0.7711. As I explained, the psychological level is 0.77 and they made a downward move during that of the European session and below that to 0.7683. But now during that of the US session, they are not making a dip. So we'll try to keep a buy limit and a stop of 30 pips. And again, they made a downward stop and they gained above that of 76.61. So we'll keep a buy limit. That was the initial low, 76.61 with stop of 30 pips. So it is buying near that of the low. In Australian dollar, they made the drop from that of 1.0355 and still they are not reached the high. Currently trading around 1.033942. So we'll try to keep a sell limit order and stop of 30 pips. So since I am showing in all the currencies the entry limits, it doesn't mean you can simultaneously take positions, and your usable margin is very important for you to take decisions with regard to the number of trades. So always keep in mind, take one position. When the going is good, you are able to keep stop at entry, think of another position. So that only in one position you will be risking at a given time. USD CAD, they are just gone above and holding closer to that other high. So we will not try to take a sell position because the net change is, in the case of USD CAD, is 56 pips positive net change and they are likely to gain it during the day. So we will not take any position there because it's quite away from that of the initial high. Then in the case of GBP and Euro Yen, Euro Yen is currently trading around 109.18 and the low is 108.54. So obviously it is in the middle level. 109.59 is the high. So in the middle level, so we will not think of a position. GBP again, 124.80 is the current level, 124 is the low, 125 is the high. So market is around 25 pips below that of the high. When they breach the high and stay above there, probably will do a technical trade of buy above that of the high or sell below that of the low. But now currently in the middle level, so we will not think of a position. Then in the case of Euro GBP, the initial low is 97.41 and still they are not breached it and they are trading around that of 97.45. So in case if the 97.78 is a high, 21 pips negative net change is seen. So in case they make a pullback to 0.8778, we'll try to take a sell. And we keep, in the case of crosses, 50 pip stop. Because in the case of crosses, the volatility will be very high, so we cannot afford to take a 30 pip stop. Then quickly they may hit it. Why I am taking a sell and buy trade? Why not I buy around 87.40? You can, or 87.41 or 50. You can ask the question. But if you see in the net change, Euro is showing negative net change and GBP is showing positive net change. So they are rising GBP, holding GBP and dropping Euro. Their intention is to drop Euro GBP. So we try to keep a sell limit order and see whether it is getting filled or not. And in case if they breach 87.41, the low, and stay below there for more than 30 minutes, we can take a sell 87.40 or 87.39. So that becomes a technical trade. So instead of simply taking a sell position when the market is making swing it within the high and the low, we can take a sell below that of the low as a technical trade. Many people do it as a breakout trade. But selling near that of the high is a wise trade. Then Euro CHF is currently trading around that of 1.0952. They again made the drop, initial drop. And the low is, initial low is far away, 1.0688 and 1.1046 is the high, 118 pips positive net change is seen. Throughout the day, USD CHF is maintaining the positive net change. So we will try to take. So this position is filled, CHF is filled. So Euro CHF will try to take a buy position, because during that of the European session, they came down up to that of 1.0933 and then went up. So we will try to keep another buy order now, 1.0935 with a stop of 50 pips. So we take the intermediary level, even though the low is very far off. We take the intermediary level up to what they had dropped and taken it up. We try to keep closer to that. In case if it is not filled, we modify and try to take a buy position afterwards. Around 1.0950 or 1.0960 also we can take a buy, provided they don't make further drop to this particular level in our observation of 30 minutes. So this is how we take the decisions with regard to entry. So only one position is being filled now in the case of Euro USD CHF, and now it made a small dip below that our entry and now slowly gaining up. So other positions are not filled. We watch for 30 minutes, and in case they are not filled, then we modify and try to take about 10 pips below. Maximum 15 pips below our limit order, but not more than that. Keep in mind, if it is not filled, we wait for the next session and then try to take near the high a sell position, near the low a buy position, and continue to trade. So this way we will be able to make mostly profitable trades. So let me minimize the PowerPoint presentation and take up the questions which are asked here. Time is up. I will try to push it very fast. Did you get stopped Euro USD? Yes. Earlier session, my Euro was stopped out, and I kept not stopped out. I kept the hedging order during the European session, and I kept stop at entry when the hedging was filled, and then subsequently it was stopped out at entry without any loss. Then continuously I kept another hedging order at 43.13 and then started making the slide when they started making the drop. And finally I kept stop at entry because the moves were very sluggish, so I want to just close it without any profit in the case of Euro. Then Anil, if the hedge trade is taken in and then the pair reverse, at what point I to take out the hedge? This I explained in my trading system. When the position is hedged, we watch for 10 to 30 minutes. Immediately we will not close the hedge. We wait minimum of 10 minutes. And if you have practiced effectively the hedging strategy, then within 10 minutes you will be able to handle the hedging effectively. Otherwise, calmly wait for 30 minutes and the market will not go away very fast, and definitely they will be inducing the traders to take such positions. We know that the hedging was filled during stop point. When it is continuously making loss for 30 minutes, then close it with a nominal loss of 10 to 15 pips. Then keep another hedging order to limit the risk again. Don't keep the position open just because you have got hedged and you have booked a nominal loss. And keep in mind, okay, I lost about 15 pips. I should make out that 15 pips in my sell position. So initially, when you think of making about 30 pips profit in the sell, you try to make about 45 pips so that you are able to handle the situation. So handling the hedging, and in the event if the hedging is making profit for 30 minutes, then we understand they are making the extended move. Then immediately we keep stop at entry in the hedging and let the market move above you or in a sell position for 2 hours. Doesn't matter. After 2 hours, either if they make 150 pips net change level or they stop cutting the new high, then you close the hedging with a profit and keep another hedging order 30 pips above, then trail it down when they start making the slide. After an extended move for today, tomorrow they will make an intentional move just opposite to that. That will be a slide. Always it happens like that. Don't think that the bullishness will continue forever or a bearishness will continue forever. They just open it with an upward stop and start making the slide the next day. That is the intentional move. They wanted to drop before that they gained the levels and booked profit with a long position and build a sell position. Then they drop the market and try to buy against their sell. This is what they are doing it on a daily basis. If you are not able to understand, then you will find market becomes very difficult. So, handling the hedge, if you learn it, then it becomes very, very handy for you. And many people have got the tendency that when the market goes beyond their control, then immediately they go in for a hedging. That becomes crisis management. In a crisis management, you just simply hedge it at the highest level out of fear. Afterwards, you see that the market reverses. Then there again, you can do it provided you come out of the hedging. But the hedging might be making about 30-40 pips loss. But you should have the mindset to accept it. If you are not able to accept a small loss, then the loss mounts. Then it becomes very difficult for you to accept the loss. Many of the traders lose money because they hesitate to accept when the loss is small. Then when the loss becomes unwieldy, they find it extremely difficult to handle the situation. Then they get angry with others without understanding they are responsible for their trades. Then Rupal. About live market quote, when they keep checking stop for showing ask and bid in the red and green, how do you interpret? I explained it many times, so probably asked it. See, now they are showing red in the case of Euro. And suddenly if it comes a green, that means it is a better improved order. Only then it takes the color green. So if they continuously show green order for 2-3, see now CHF we got it filled and they gained it. See, you can see that green order follows up. That means they are gaining the levels. And red order comes and follow up red order is not coming. Still lower level is not coming. So when it shows red and not dropping below, you can take a buy. So you can fine tune your entry based on these indications. Hope you are able to understand that. And at times they show the signals. They show a higher bid or a higher ask. That means they cross check whether the stops are there above that of the high or around that of the high. And if there are no stops, only in the limit, they understand that the traders are long. The stops are closed and the traders have taken the buy position and kept the limit order to exit out of the positions. So they don't simply give profit to such traders, they drop it. That's all. So they don't give either way the profit to the traders so easily, whether you are bullish or a bearish. Only if you are smart enough, you will be able to earn from that other market. Then Rupal. Okay. And when they show black, so when they show black, that means there is no fresh order coming in. The order remains there for more than 15 seconds. Then automatically the color changes to black. That means the market is subdued or waiting for a data release, etc. Then there will not be much more. So when the black comes only when the market is in the middle level, not near that of the high or not near that of the low. You would have noticed it. Rupal. And when they show, okay, then AL, you risk 30 pips to make 14 or pips. Very risky. No. I keep initially 30 pips in order to close the position near that of the low. When the going is not good, I am willing to accept a small profit. So just because I have taken 30 pips risk, if I wait to make 60 pips, then when that position is not making profit for me, I cannot push the market to give me 60 pips. I have to accept the reality and book minimal profit. So because on every session I am willing to trade and I am not looking for a specific opportunity. And even when you look for a specific opportunity, an extreme move, invariably you can ask any of the traders in the world whether they are taken at the highest level a sell position. Very few would have taken it because the fear is in every trader's mind. Okay. What is ES before 30 pips? Entry stop. Because in most of the trading platform offering the hedging they are called as entry stop. Okay. Then Arun. What about Australian dollar? Okay, Australian dollar, they are not breached the high, they are not breached the low, they are just come to that of the middle level, and it is showing a net change of 34 pips, negative net change. So anybody who has taken a buy position yesterday, still he has not been given an opportunity to book profit. That's what it implies. So during the US session, towards close of the weekend, such people will come for long liquidation. You know, on Monday they made a drop to 0.9929. Many people would have taken short position also. That is why there was a pullback during the same day, and they would have covered the short. That is why they are not gaining further up. And if they are not covered the short, then definitely the players would have gained at least 1.05 level. They have not done it. So it shows that the traders have quickly exited out of the short position and turned long. That is why market is struck here with a negative net change, and slowly the market is expected to come down, but the players are holding here 1.03 and building sell positions. And you know, at 1.10, when I was telling that they are just going to drop it below parity, and people are just yelling at me. And so this is what we need to read from that. What appears bullish is not really bullish. The players are building sell positions. So when the players are building sell position, can it be bullish? It's my simple question. Would you say that it is, okay, Rupal, by chance there is an open position for weekend. Should we hedge before close? You can do it. You can hedge it so that you will be able to limit the risk to that particular level, and always you can handle the hedge. I explained it many times how to handle the hedge even when you are away from that of the trading platform. Suppose I hedge a position because I have to immediately attend to a medical situation. So I simply hedge my position and just go and attend it. After about 5 hours or even after about 2 days, I can come back and look into that other position. When I find I'm not able to understand where the market is going, I can simply close the original position with the hedging, similar to using a stop. And in case I'm able to see that my sell side is making huge profit, the buy side is making a loss, but the difference between the loss and the profit is only 30 pips. And if I close a buy position or a sell position, and if the market moves in my favor, 30 pips, I am at break even. That way also you can handle it. Otherwise, when they are making range bound moves, let them make a downward move. Let me book profit in my sell position like a bear. Then let them make an upward move. I am willing to book profit in the buy side like a bull. So there are traders who hold the positions without stop. It is similar to that, but we are not risking our usable margin. So there are various opportunities available if you use hedging. Then Boyke, would you say this is a breakout trade? In the case of USD CHF, I had taken a breakout trade. Breakout in the sense the psychological level, I just watched it, and then closer to psychological level, I had taken a buy, even though I had not taken a buy below that of the, near that of the low, because that opportunity is not going to be given. And they gained the level, and I just watch how to what level they came down during the European session to go up. Similarly, in the case of Euro CHF, up to what level they came down and then go up. So accordingly, I try to take the positions. Intermediary levels also, we can watch it in the live market code page, and you can take positions. Otherwise, you can use chart and see up to what level, intermediary level they came down, and then that acted as a support. They are supporting. They are buying at that level. You can use it to make a buy also. Then Prince, do you see GBP cutting the daily low during that drop? See, GBP, they gained the levels in order to drop Euro GBP. They have breached Euro GBP. That is why I have not taken the buy position when I explained it. And below that, 97.40, they can take a sell. If they sustain below that, even now we can take a sell. They will make a drop because Euro, they are making a dip. GBP, they are holding the positive net change and a negative net change. What more evidence you require to take a sell and buy a trade with this? So it is very easy to look into that of the live market code page, understand what sort of trade we can do at a given time. So we don't have any sentimental attachment to any of the currencies. We don't analyze individual currencies. Collectively we watch and try to take positions. Whichever the currency which can immediately give us profit. Our objective is to make money from that other market. Nobody is going to reward whether you buy euro or whether you sell euro, unless and otherwise you book profit, because these are all leverage trading. And trade. Are you buying or selling euro CHF? I have taken a buy position in euro CHF. I have kept a buy limit order, but they are not filling it. And could you show your gap time chart? Again, I will show the slide. Then, Jason, what about USD CHF? I have several buy positions with good profit. Should I liquidate? See, there comes the biggest problem with regard to the emotional traders. When the position is making loss, we try to hold the position. And once the position makes profit, immediately we want to grab about 10 to 15 pips profit. This is the normal mindset. But as I explained, you keep stop at entry in the profit making positions and try to maximize the profit when the going is good. There comes your smartness. Or tail the stop about 30-40 pips away from the other market so that you will be able to get the maximum profit out of that. Okay, all the good profits. Thank you. Boyki, do you use charts? I was using charts about 15 years back, and I found that I was not really heading. Then I stopped. Now I use only the live market code page to do all my trades. Where do you see them going before? Okay, I don't have much time. I have to wind up for the next session. And I take this opportunity to thank FX Trade for the nice opportunity given for me to present this webinar, and also you people who are kind enough to attend to this webinar and listen to me and try to make use of these ideas if they are suitable to you. Thank you one and all. See you again on Monday during Asian Session Live Market Analysis. Thank you one and all. Bye. Wish you a very happy weekend.